Hello, everybody. How are y'all doing today? So my name is Ryan Grody. I'm our Supply Chain Solutions Analyst, and today I am going to kick it off with some ocean updates. So this first slide that we got pulled up here, this is our outbound ocean TEU index. This is measuring TEU containers outbound from China to the United States. So this is showing that over the course of a year, that volume's currently up about 8%. You can see that we've talked a lot about the potential pull forward in anticipation of potential tariffs, and you can see that that surge in volume from China to the United States, we saw kind of an abnormal bump in the earlier months of the year. Next slide. This is that same chart, but this is on an absolute basis. This is our seasonality showing year over year. What you can see here is that current year, we're up over the 2022-2023 levels and just under those 21 levels. So if we can all remember 2021, that was a year of great freight demand, and surprisingly enough, we're looking to be pushing up on those levels again. Next slide. This is the relative chart of inbound ocean TEUs to the United States. So as you can see here, kind of no surprise, US, China is our #1 trading partner. So we can see here that same up 8% over the course of the past year with that same volume surge in those earlier months of the year. That July, August, September, we saw those TEUs were up about 30% going into this fall month. Next slide. This is again on an absolute level. So we're showing the same theme here. We see a lot of that pull forward. The 2024 year in TEUs inbound to the US is showing a lot of strength. If you were here for the great debate conversation with Zach Strickland and his counterpart, there was no real debate around weakness in demand. This has been you could argue either a recession or not from a supply perspective, but demand has remained strong throughout the year, and we can see that here. Inbound TEUs to the US. Next slide. This is our inbound TEU volume index into the largest port on the East Coast. So this is a clear distinction that volume is certainly up over last year. Going into New York and New Jersey, what you can see there in that yellow line is that's that 2021 surge in volume. So that's going to be our all-time highs. But what we can see here is we've certainly pushed up on those highs July, August, September. If you go to the next slide. And then this is our inbound ocean TEU volume index going into the largest port on the West Coast, so into the port of LA. And what you can see here is that we are in fact up at all-time highs over the past 4 years, surpassing 21, 22, and 23. And this will be a nice segue into the intermodal that will be discussed in a little bit. But if you go to the last slide, what we can show here are rates. So this is the Freightos Baltic Daily Index, China to the West Coast and also China to the East Coast. So the blue line there is China to the West Coast, and then that lighter blue line is going to be China to the East Coast. And what you can see is we've certainly come off those 22 highs where we were seeing container rates at about $15,000. We saw them bottom throughout 2023 into 24, below 2,500. We've seen them since rise, eclipsing 7,500, almost $1,000 a container. Those have since fallen off. We do expect rates to continue to fall as capacity continues to come online. We forecast ocean capacity coming online at about 2 to 3% a quarter. And then there's the question of if the Red Sea opens up again, that'll be added capacity. So we do expect these rates to fall. But the general theme with ocean freight is that the demand is still there, and it's been there throughout the year. I'm going to bring up next our intermodal expert, Mike Baudendistel.
So Ryan was just speaking about all the import volume that's been coming on and has really been strong. It's really translated into a lot of intermodal volume as well. What we have here is my O-Rail DOML chart. So what that is 53-foot loaded containers. This is a data series that's a favorite of financial institutions that trade J.B. Hunt, Hub Group, and Schneider. I think it's a reasonable representation of their market, and you see that white line at a very high level, roughly in line with the blue, which is 2020 levels, and well above last year, which is the pink line, which you saw some dip at this time last year, up about 7% year over year. So usually you get into this part of the time of the year right before Thanksgiving, and you start to see a little bit more of a drop in domestic intermodal volume. Really haven't seen that this year. October is typically the strongest seasonal seasonal month for domestic intermodal, and that's really persisted all the way through late November, which would attribute a lot of that to the import strength that Ryan was just talking about, and additional transloading from international containers into domestic containers. And want to go to the next slide and talk about the other segments within intermodal, which is international intermodal. So this is going to be your 40-foot containers or 20-foot containers. There's still some 45-foot containers in there as well. And you see the white line is 2024. And that had really been the story of intermodal for about the first half of the year, where it was up 20, 30, 40+%. Just heard when Union Pacific reported their third quarter, they were almost apologetic. They moved so much international intermodal because it diluted their operating ratio because it's a lower rated freight on a revenue per unit basis. But international has really been strong. That's the one that correlates most closely with the import strength that Ryan was just discussing. But if you look at the right part of that chart, it has come off a little bit. The last few weeks would attribute that to a little bit of disruption in the international intermodal network. Maybe a little bit of more transloading into domestic containers, and there's been some stories of shortages of ocean-going containers, which that leads to more transloading. Started hearing reports of that right around the time we had our last conference in Atlanta, and ever since then was really when domestic intermodal really started picking up more significantly. I want to go to the next slide, which shows an illustration of something you can look at for transloading. One of the questions that I got the other day from one of the Class 1 railroads is, do we have anything in the SONAR data that would show how much transloading volume there is from those international containers into the domestic containers when they try to evaluate their two segments? And there's nothing directly, but you can look at our containerized intermodal volume and look at what that implies. And that white line is this is the past 3 months, and in the past 3 months, domestic intermodal is up about 6% in terms of volume. Meanwhile, international intermodal down about 4% from where it was 3 months ago. So I think it's safe to say there's a little bit more transloading into the domestic containers, so that's going to be good for the volumes of a J.B. Hunt, Hub Group, Schneider. You do see in that orange line, that dip in the middle. That's right around the time of the ILA strike. I want to go to the next slide. Also, we'll promote what I talked about earlier in the day. If you were not here, we are launching intermodal contract rates by lane for 67 lanes and 2 indexes, one for a transcontinental head haul index outbound of LA. That's going to be the blue line, and then a local east index, which is the average of 10 lanes from Chicago points eastward. That's going to be the orange line, and on the left axis. So we're looking at $1.73 a mile on average for those transcontinental lanes, and $2.02 for the local east lanes. And so local east rates are higher on average, and you see how those have changed the past 5 years. They do kind of move directionally, but those local east lanes are more volatile. You see it came down more in 2020. You've seen it maybe come down more the last couple of years. The local east lanes much more competitive with the truckload market. It has been more influenced by the loose truck market the last couple of years. So we'll keep an eye on these intermodal contract rates, ticker IMCRPM in SONAR. But I think they've gone about as low as they're going to go, and I think when we get into next year, we'll start to see some strength there, based on some of the volume we've seen and some of the comments lately from the domestic intermodal companies. So with that, I'll turn it over to Zach to wrap things up.
Thank you, Mike, for that. And let's wrap things up with some truckload and trucking market data here. We've got the outbound tender rejection index. Is the freight market tight? No. It's below 6% on the tender rejection index. The white line you're looking at very closely tracking with the 2019 line. If you've heard us talk about this at this point, the fact that we are almost mirroring 2019 historically a loose freight market environment, deflationary rates, lots of carrier exits. We're right in line with that. Now, will that spike at the end of the year show up? That will be the million-dollar question that everybody will want to know. I don't know if we're going to see a 15, or I guess it was right around 14.7% in total at the end of the year there. But it was a very brief, short-lived spike, just a matter of a couple of weeks that it was up there. So I think that it's likely that we'll see a spike. Obviously, we call this peak season because capacity tightens pretty dramatically. If you heard my spirited debate with Noel Perry this morning, we had a nice back and forth there. But we are going to see a peak. Now, is that peak going to be exponentially tighter? That's the big question. I think it will be much tighter than it was this time last year. If you look at that pink line that's underneath that, we're already moving above what it was last year in early November. That is the takeaway. We're tighter than we were. Are we all the way back to a market that is going to be tremendously volatile and tight? Not quite yet, but the signs are there according to the Tender Rejection Index. Now, outbound tender volumes combined with the outbound tender rejection index, the reason this is important to look at with both of them on here, tender rejection rates in the yellow line are moving one direction. Demand in general, except for yesterday, we had a bit of a trough, is moving the other direction. Tender rejection rates, though, and tender volumes have had an inverse relationship, meaning they're moving in the opposite direction over the last 2.5 months. This is a very unusual situation, meaning that carrier networks are obviously getting more strained and more pressure. A lot of this has to do with the fact that they have to deal with a lot more long-haul demand coming off of Southern California. It's a very unbalanced market, unbalanced situation, which is, of course, straining things. Does this persist into the new year? I think the import volumes, as you heard Ryan and Mike Baudendistel talk about, there is definitely going to be that component moving into Lunar New Year and certainly the first quarter. Now, January, February, not necessarily the most robust freight market environments in general because the sense of urgency is much lower for a lot of shippers. So we still have time to see there, but I think we are in a definitive moment where capacity, we see the signs, that has come offline enough to create a non-demand side environment where there is enough pressure on the market. Looking at contract and spot rates, this is the chart that I showed earlier on our debate. Contract market flattening, and now over the last 6 months or so, starting to show signs of increasing. It has no reason to do this. If you look at the spot rates, they're moving higher, sure, but they're not close to the contract market, meaning that they're not close enough to really create the pressure. Tender rejection rates just recently got above 5% consistently. Certainly not what we consider an inflationary figure for the contract freight market. What you're looking at is simply the fact that people are expecting the market to tighten over the next 12 months. If you think about contract rates, what are they? They're long-term versions of the spot market. The spot rates, of course, they're negotiated on a daily basis most cases. The contract rates also build in expectation. So there's the expectation that is now starting to manifest in the long-term rates that they are now moving higher. All right, and now breaking it down into the various rejection rates into the various modes, refrigerated, flatbed. So if you look at the green line, I should have made that blue because that makes more sense. That is the refrigerated sector, the temperature controlled. Those rejection rates have been moving the most rapidly, the most volatile over the last bit. They have a pretty big decline here in the last couple of weeks, but I don't know that I'm that concerned about that being the trend. Now, we're going into Thanksgiving. This is very seasonal to see refrigerated start to percolate quite a bit. But I think this market is ripe for a much more volatile period of time. Flatbed starting to wake up a little bit, certainly into next year. That will be a moment to watch, especially as construction and capital expenditures start to become more of a thing. Van, I know it doesn't look as dramatic, but it's moving higher, and that's the point. So it's still around 5%, but the directional shift to a higher state of being is certainly one to monitor, especially as we hit Thanksgiving and Christmas coming up. Last chart here. We've got tender rejection rates for Los Angeles and Chicago. So I've given you the high-level overview. Los Angeles, we talk about it all the time. It is the centroid of the supply chain in the United States and for everything that comes to the retail sector out east. Rejection rates are spiking and continuing to go up. Chicago is a natural jumping-off point. Rejection rates are definitely getting more volatile and reactionary there, as you see in the green line. Point being, Watch these two markets closely over the coming months. I think these are going to be the tells on whether or not we're truly out of the freight recession or not. And that will do it for me. Thanks. Have a great rest of the conference.